Bitcoin is the apex property of the human race. There is no property invented in the history of mankind that is better than Bitcoin. Not land, not gold, not silver, not stocks, not bonds, not the giant stone coin of the Yap people, not NFTs, not art, not baseball cards, nothing.
BitSwap is the hottest new way to trade tokens. Crawling all the top decentralized exchanges, BitSwap gets you the very best price and value for your trades. BitSwap is changing the game. Try it now at bitswapdex.io. Welcome to BitBoy Crypto, the largest crypto channel in all of the interwebs. My name is Ben. Every day on this channel, I show you how to make money in cryptocurrency. If you like money in crypto, make sure to hit the subscribe button. Also, check the video description on details on how you can win one full Bitcoin if you subscribe to the channel. Today, guys, I interviewed Michael Saylor, and this is a big one. You're definitely not going to want to miss what he had to say. What he had to say about Bitcoin even shocked me and possibly made me think I could even be wrong about a lot of things I believe about the oldest cryptocurrency. See if you agree in this interview. Here we go. Hey, guys, today I'm honored to be joined by Michael Saylor. Some people call him Mike. Obviously, the CEO of Microstrategy, and one of the biggest names in Bitcoin. He's a folk hero to crypto for sure right now. Got Elon Musk in maybe. Well, I don't know. I might talk about that. But Michael, so glad to have you on the show today.
Thanks for having me.
Absolutely. The first thing I want to ask you about is when you do interviews with, like, let's say someone that's crypto oriented versus someone who is more traditional finance oriented, like CNBC. What is the differences you see in the way that they approach, your take on Bitcoin?
I think the crypto-oriented interviewers have a much more intricate technical view, and they typically want to look at Bitcoin versus all the other altcoins. Whereas the mainstream media and the mainstream interviewers are generally don't have so much of an intricate understanding of either the technology or the philosophy, the underlying theory of crypto. And so they're more interested in probably just the major investment themes. And oftentimes they're interested in my views as a corporate public company CEO, because they relate to that. Whereas in the crypto community, they're a lot more interested in the nuances of crypto and the differences in approach. Yeah.
Yeah, sometimes when I'm watching interviews you do with CNBC or other entities, I'm just like, I want to know what's going through your head, because like they ask you questions that are just like so asinine sometimes. It's like almost like to be so intelligent and be so involved in the traditional finance world, like they can't grasp Bitcoin. Like, what do you think is the thing that holds them back from being able to really understand, that this is not a stock, it's something totally different?
A frame of reference. I think if you have a certain frame of reference and you've always lived in that frame of reference, then things that are moving through your frame of reference look like they're in motion. Whereas if you have a different frame of, maybe a broader frame of reference, and you step back, you interpret it differently. It's like if I kick you off a mountain and you're falling, and you understand the big frame of reference, you understand that gravity is pulling you down. The mountain is not rising. The mountain is not a bubble. The mountain is not rallying. The mountain is, you are falling, right? You're in free fall. But on the other hand, if you have a very strong ego and you can't imagine free falling ever, you think the world revolves around you, your view is, oh, the mountain seems to be going up at and what is the word, like a unsustainable rate of growth. There's a bubble in the mountain. There'll be a regression to the mean. Nothing can be that tall. Eventually the mountain will come back to earth. I think the best example would be if I'm a mainstream investor and I look at my performance over the past 12 months, I think I'm a genius because my stock portfolio has been going up. And so I actually think I'm a really good stock picker. The famous example of, look at what we did in the federal government. We made the stock market go up. So that's a frame of reference. But another frame of reference is we just devalued the dollar by 30% and
Exactly.
the stock market is constant. So which of those two frames of reference do you have? And if you are so incredibly steeped in the one frame of reference, you can't imagine the other.
Yeah. It's paradigm shift. And a lot of people have a hard time with that. And, I've interviewed a lot of people that have, made a lot of money in traditional finance. And it seems like those people, they're very comfortable with how they've made their money. And I think, projecting in the future and thinking about what things are going to look like in technology and with cryptocurrency, they don't even want to think about that. They just want to think about, this is the way I've done it before. This is the way we made our money and we were happy with that. And those people don't want to change. I mean, if you look at Warren Buffett, for instance, doesn't own a lot of tech stocks, it's a little beyond, his expertise. But in reality, like, that doesn't mean tech stocks were not going to crush it. Does that make sense?
Well, I mean, again, let's talk about frame of reference. If you've lived in a world where investing was synonymous with choosing stocks, and most of Warren Buffett's writing is all about choosing stocks. Yes. If investments are synonymous with choosing stocks, then of course the success is to choose the right stock.
Right.
But I can, if you lived in the Weimar Republic, or if you lived in Venezuela, or if you lived in Zimbabwe when the entire currency crashed, then, there are many, many macroeconomic frames of reference where no stock works. Yeah. In fact, there are macroeconomic situations where all of the value drains out of the stock, but not out of the debt. Like a company can have a capital structure with $1 billion in equity and zero debt, or $1 billion in debt and zero equity. So if you take a broader view, you could say, well, it's possible that you can make money in debt but not equity, or it's possible you can make money in debt and equity, or it's possible I can conceive of a situation where the currency collapses, you can't make money in debt or equity. Right. And so therefore, I think that people that have lived in stable environments where all of the components, the relationship between debt and equity and currency and real estate and tax, all of those are stable, they can form models and they can form heuristics. And then you can look back at the model and use it. But if I were to change maybe the gravitational constant, right? The force of gravity, if I doubled it or tripled it, all of your architecture textbooks and all of your tables
are all wrong.
They're all wrong.
Yeah.
And so I think the difference is, if you're an engineer and you can reason from first principles, then you can take a clean sheet of paper, and when you have a massive macroeconomic paradigm shift, you can rederive your models. We call the difference between understanding the homogeneous solution, the differential equation, or the particular solution. The particular solution is a lazy person's solution to the problem, and it works 99% of the time, a million times faster, as long as nobody changes all of the underlying premises and boundary conditions. Yeah. And so people get lazy and they live with that little particular solution. And then when one of the premises or one of the boundary conditions changes, all your particular differential equations are worthless. And then you have to derive from first principles or underlying math. And if you're not a good mathematician, or if you're not capable of deriving from first principles, you're a totally fish out of water.
Yeah. Well, I'm just lucky. I grew up when we were not allowed to use calculators in our class, so I'm good at math.
I'll give you two other examples. One, a lot of basic investment principles work if the cost of capital is 8%, and when the cost of capital goes to 24%, like value stocks don't work anymore, right? And by the way, misunderstanding inflation. If you think inflation is CPI, but the real cost of capital is 8%, you're only off by 6%. And you've got a bias in your analysis, but it's 6% and divided, into the rule of 72. It means that your mistake's going to be egregious in about 15 years. So you're kind of making a mistake that manifests itself over a decade. But when the cost of capital goes to 24% and CPI goes to 0%, then your error is going to manifest itself in 36 months. Yeah. And so if you really misunderstand something when the numbers change dramatically, then your bias becomes fatal. One more example, all these people living with their charts and their models, right? Charts only work in the rear view mirror. So
Absolutely.
if you're in a closed system, and the economic actions and the economic wherewithal of all the actors and their behaviors are all consistent and reoccurring with some cyclicality, you can use charts and models. But if it's an open system and I introduce some external new actor into the system, all your models are irrelevant, all your charts are irrelevant. And you know, the colloquial example would be, you study kids playing basketball in the school playground your entire life, and you know generally how that ends. And all those models are useful, except when Godzilla shows up to the playground. And then it doesn't matter anymore. So the world's full of, I think, conventional macroeconomists and conventional investors and conventional media. And they have been doing the same thing for 30 years. And they thought that 10 years ago, they modified, tweaked a few models, and they're doing great for 10 years. And in the last 12 months, every financial portfolio, with the exception of long bonds, is generally up. And so if you were smart enough not to be holding 10 to 30-year T-bills for the last 12 months, you can tell yourself that you're a genius, and you can ignore rebuilding all your models. And so I really think the conventional investment community doesn't have this urgent need to throw their models away and rebuild them, because the S&P and the NASDAQ are cushioning this paradigm shift.
Yeah, I think so. And, you know, I think we know a lot of these models and a lot of the way that our government calculates, you know, inflation and different, you know, even if you go to unemployment and things like that, that they're always changing the game, and it's always smoke and mirrors to try to make themselves look better. And I think we see that too. But what I want to ask you is, you know, MicroStrategy, obviously your company, I never heard of them before you guys bought Bitcoin. And now it seems like Bitcoin is kind of become your model. And I want to get into a lot of that. But I want to know specifically from you as a CEO, like, what makes you different than all of these other traditional finance people that we're talking about? Like, what was the moment for you where you got it? And like, when was that? Talking specifically about Bitcoin.
I think by the end of the second quarter, what I realized is we had a low growth, cash rich company. We're going to generate $75 million a year in cash flow for the next decade. We weren't going to grow 20, 30, 40% a year. We weren't, you know, the next screaming Zoom. We were going to have a stable, mature business that made a lot of money. And we had a block of $500 million of cash on our balance sheet. And I realized that no one cared, and we were viewed as being utter failures, almost to be discarded by Wall Street. It's almost like no one in the world wants to invest in a company that generates cash, that's well run with a huge amount of cash. And I thought, what is wrong with us that we're so hated? Like, what? Like, you have a decent business, you know, you run a restaurant and you've been serving people for 30 years, and it's a great restaurant, it's the best in the city. And when somebody shows up and they tell you your restaurant stinks, you're awful, you should just roll over and die, you think, what? Really? Like,
well, people tell me that every day.
Really?
So I'm very familiar.
And so we realized that we had a good business and had a lot of cash, but the investors valued the cash at zero. And they valued zero growth at zero. And then we started asking the question, why is it that the world values excellence as zero unless it's hyperbolically hyper growing or parabolically growing? And why does the world value $500 million at zero? And that got me thinking. And what I realized is cost of capital had gone from 8% to 20%. And they were discounting the cash. And the assumption was $500 million of cash is going to be worth nothing in a decade. And I thought, well, that kind of scared me. And the next thought was, if you can't grow your company 20% a year, it's worth nothing. Well, okay, so why is it worth nothing? And the answer is because the currency is collapsing. And so once you understand that, then you realize you've been put in this quandary by fiscal policy, which is if you have a company and you can't grow at 20% a year, you're going to fail. And then you realize that if you're an employee, if you're working for a living and you're not raising your salary 20% a year, you can't keep up. And once you realize, and then you understand why, once you realize the why is because we're discounting the cash flows at the risk-free rate of 20%. And at a discount rate of 20% or more, nothing works. That causes you to realize that the only strategy for survival is to become asset rich. And of course, we saw that with the K-shaped recovery. Every Wall Street finance company had the best year of their life doing very little, right? Like if you'd done nothing and just held the S&P 500, you're up 35%, which is like the best year in a decade, doing nothing. Okay, and then every Main Street company had the worst year of their life. If you manufacture things with manual labor and people, it was horrifically difficult year. And if you did nothing but held stocks, it was your best year of your career. And so once you understand that, you realize that you can't succeed in business. And by the way, you can't succeed in life if you don't actually create an asset portfolio of high quality assets that will appreciate in value faster than the rate at which the currency weakens. That's the epiphany, right? And it had been building up for a decade. But your frustration, if you feel like, well, everything's getting 7% more expensive every year, you can imagine you're going to get a 7% raise, and maybe next year will be better, and you'll get the double raise. You keep hope springs eternal.
Right.
But when the cost of capital goes to 21%, and then you think it's going to go 21% every year for the next 10 years, at that point you realize, no, this is hopeless. And so I think we were just in this situation where, our stock was like, it went down to $90 a share. We were in the tank. It was at $120 a share. The company's valued at 1x revenue plus cash. And if you ask any investor, well, why do you hate us so much? The answer, you're not growing fast enough and we don't value the cash at all. Okay, well, I guess you can basically rail against the investors in the market and say they're stupid, they just don't get it.
Yeah.
Or you could say, well, maybe they're trying to teach me something. Maybe I need to learn. This is a learning moment. And so I guess we got to the point where in the second quarter, we realized we were never going to need that cash to grow the business. The rules of the game had changed, and you couldn't use money to grow the business. You can't use brute capital, nor can you use brute labor in order to grow a manufacturing company anymore. And then we realized that the cost of capital had tripled, and it was just going to boil off to nothing in any event. So simultaneously, that was kind of like permission to do something different. Maybe permission plus instigation to do something different.
I like instigation. It makes me do things as well. So the question is, you guys have bought so much Bitcoin. Grayscale right now is the #1 company that owns Bitcoin. MicroStrategy is #2. Does that bother you? Do you want to be #1?
Well, they have an advantage, which is
they do have a little advantage. I'll give it to them. Right.
Right. I mean, the difference in MicroStrategy and Grayscale is Grayscale's a trust and they're getting paid 2% of the Bitcoin in a fee every year.
Right.
MicroStrategy's owning it all to the benefit of our shareholders. Right. So I think relatively speaking, we're all fine because we're the principal. We're not the trustee. But would we like more? Yeah, we would like more. We would like, and our business strategy is, look, we got two business strategies. We got a P&L business strategy or an operating strategy, and we got a balance sheet strategy. And I think, by the way, every person on earth and every company on earth needs two strategies. The first strategy is how am I going to make money? And the second strategy is how am I going to invest my money? And so our operating strategy is we cultivate our enterprise software business and we grow it, to the extent we can, and we make our customers happy and we make money doing it. And that's business intelligence. And we'll continue to do that. Our balance sheet strategy is acquire and hold Bitcoin. And by any means that is accretive to our shareholders. So as we generate cash flows from our core business, we sweep them into Bitcoin. If we can sell equity and we think that's accretive, we'll do that. If we can sell debt, we'll do that. And if we have any other intelligent financial structures, we'll do that. So far we took some capital out of our treasury, bought Bitcoin. Then we did a Dutch auction, which is kind of like an equity offering.
Right.
And at the end of that, we bought Bitcoin. And then we did a convertible debt offering for 650 million and we bought Bitcoin. And then we did another convertible debt offering for $1 billion and we bought Bitcoin. And then from time to time, we get extra money and we buy Bitcoin. So
I love it.
that's the strategy. We just keep working it. It's very simple and straightforward. Buy, don't sell, don't hedge it. Don't get too complicated. The way I view it is like, if you showed up in Vegas in 1950, and if you thought to yourself, one day the world's going to want a convention center in the desert that supports gambling with big hotels, and this is the right place to do it, then you would buy as much land as you could in Vegas. That's what Howard Hughes did. And if you could borrow money to buy up all the land in Vegas, you would do that. And then maybe you develop some hotels or casinos or convention centers, or maybe you just keep buying land in Vegas.
Yeah,
right?
well,
You're developing that property.
So yeah, and that brings me to something else, because you guys are sitting on a lot of Bitcoin right now. I think you've almost got 100,000. I think you got like 93,000, about 225 more, or somewhere around there here recently. Like I think it was yesterday or today. What are you guys doing with that? I want to cover that.
Okay, so to give you the exact number, we have 91,326.
Okay.
That's what we have as of right now.
Almost 92,000. I don't want to put the horse in front of the cart here. Okay. But the question is, I want to go two different places with this. Number one, what are you doing with that Bitcoin? Is it just sitting with a custodian somewhere? I'm not going to ask you for your private key.
We're hodling it, in a nice, safe place.
And so the question is, if you guys are sitting on 91,000 Bitcoin, and there's all kinds of ways out there for you guys to like stake that Bitcoin or earn returns on that Bitcoin with a place like BlockFi or Celsius or some other third party, is that something you guys are interested in doing at all? Or are you guys just saying like, we don't care about those extra returns? Because that seems kind of counterintuitive to your investors.
Okay, well, first of all, Bitcoin's been appreciating against the dollar at 200% a year for the past decade.
Yeah, it's doing pretty good.
Okay, this year it's faster, right? I mean, this year it kind of accelerated to like 400% if you discount the Black Thursday, whatever, which which is even faster, but it accelerated. So more than 200%. You're buying the thing, it's appreciating 200% tax-free with no counterparty risk. If you were to offer me 8% interest to loan it out, or to trade, if you offered me 12% interest to trade the futures, I'm going to end up incurring a 35% tax rate on that.
Boom.
Some number. So your 12% yield becomes 8% yield. And I go from 200% to 208%.
Negligible.
It sounds like a lot if you're thinking about it versus zero. But it's really 8% on top of 400 and on top of 500% this year. So really it's like 1% after tax, maybe 2% after tax more. If you look at the counterparty risk, it's huge. We could lose it all.
Yeah.
If you look at the security risk, you have to move the stuff around through different custodians. It's a security risk. If you look at the accounting challenges we're a public company. We'd have to establish ourselves that we're comfortable with the controls and the disclosures and the annual reports of the counterparties we do business with. And then we had to figure out how to disclose that risk and quantify that risk to our shareholders. So by the time you get done with the accounting, the lawyering, the execution, the paying of the taxes, the deciding how to execute it, you realize that you made the business 10 times more complicated, 100 times as risky to make 1% more money.
Yeah, that's a good way to sum it up. I mean, that's kind of how we feel here, is that, even for us, we don't have 92,000 Bitcoin by any stretch, or 91,247, whatever it was. But I mean, we've got a pretty good bit, and it's hard for us. It's just like an extra step. There's all kinds of things you have to do, and then you have to take care of it, and you are risking, you're trusting somebody else. And for us, like for me personally, like I'm way too busy to even take care of it. So I'm having to trust another person to do it. So definitely gets quite complicated. So I understand that. So that's on one side. Like, what are you guys doing with it in terms of staking? Sounds like it's just not worth it to you guys right now. I get that. Let's go on the other side. You said you're just hodling it. So there's a narrative that I'm sure you're very familiar with the Bitcoin cycles, with the 4-year cycles, following the halving and things like that. There's a narrative out there that all of the big corporations and all the institutions, the big investment funds, they're buying Bitcoin right now and they are not going to sell it. And that's going to make us not go into the same kind of bear market that we've seen in the past. Is that your strategy? Is no matter what, like even just take into consideration, there is going to be a bear market and you guys are just going to hodl through it and not care if the price goes down, 85% again. What is your take on that? And how are you guys handling,
So Ben, just a basic set of principles. First of all, Bitcoin is the apex property of the human race. There is no property invented in the history of mankind that is better than Bitcoin. Not land, not gold, not silver, not stocks, not bonds, not the giant stone coin of the Yap people, not NFTs, not art, not baseball cards, nothing.
I love it.
Okay. So it's the apex, it's property. It's also the longest duration asset. That means there's no reason you can't hold it for 100 years.
Yeah.
It's better than owning all of Manhattan. It's better than owning, the center city blocks of the greatest cities in the world. This is like Manhattan in cyberspace. One day 1 billion people will live there, then one day 5 billion people will live there. So I'm telling you, 5 billion people are going to want to own property in cyberspace. There's only 21 city blocks. How long are they going to want to own that property? How about like 1,000 freaking years?
Yeah.
Right. Like there's no reason why the property isn't good for 1,000 years. It's an open software protocol that's only going to get better over time. The English language has been around for quite a while, right? How about Arabic numbers? Been around for quite a while.
Yeah.
A protocol can last a long, long time. So we've got this issue of, is it long duration? Yes. Is it high quality? Yes. When should you ever sell an asset? The theoretic, and this is why people like the models are all just misleading people to make awful dilutive decisions, destroying their wealth. The only time you should sell an asset is when you have knowledge it's going to be impaired, right? You can't take it with you. It's going to be impaired and you can't finance it to buy the next asset. Well, this is not going to be impaired. This is property in cyberspace, right? And there's nothing better to buy. There's nothing better to buy, right? I mean, I'll say it a third time. There's nothing better to buy. So if you're buying something which is potentially going to last hundreds of years, and there's nothing better on earth to buy, why would you ever sell it? Yeah. So that's the first point. You're trading it for what? Trading it back for, you're trading a strong asset for a weak asset. In nature, there's a flow from the energy flows from the weak to the strong, right? Water flows downhill, energy flows from the weak to the strong. In free markets, capital flows from the weak asset to the strong asset. In currency markets, it flows from the weak currency to the strong currency. So it doesn't really make sense to trade out of that ever. Let me make one more point. All those models, they're irrelevant. As I say, they're irrelevant. Like the 4-year halving, irrelevant. All your back tested models for the past decade, irrelevant. They're all based on history. Okay. They could only be relevant if there were no external actors or external energy sources. When Godzilla comes to the playground, your models of who's going to win the pinball tournament are irrelevant. You could tell me, I've been at this pinball tournament for the past decade, and I know that always like the two dudes on the left side of the table win because there's a tilt in the table. When Godzilla blasts your pinball table, it's irrelevant. So the halving, what does that mean? It means nothing because all these miners are coming public. And as they come public, they're going to have access to infinite, cheap, or free capital. They're not going to sell any Bitcoin. They're going to buy the Bitcoin. Stock to flow is going to infinity. Then stock to flow is going negative, right? When all the exchanges and all the miners of Bitcoin are public, there's no reason why they couldn't issue billions and tens of billions of dollars of equity and debt and buy Bitcoin. Well, why would you buy Bitcoin? Well, my investors want the Bitcoin. Well, what if the investors don't want the Bitcoin? What if the investors hate Bitcoin? Well, if investors hate Bitcoin, they're not investing in publicly traded Bitcoin miners, are they now? Right? Nobody's investing in a publicly traded Bitcoin exchange or publicly traded Bitcoin miner or a publicly traded Bitcoin company if they hate Bitcoin. So as the shareholders rotate, what you realize is there's no rational reason for anybody that ever earns Bitcoin or creates Bitcoin to ever sell the Bitcoin, which means that the stock to flow doesn't matter, which means the halving doesn't matter. What matters? What matters is when someone shows up with $20 billion and they want to buy Bitcoin, that matters. What happens, if Tesla buys 10 billion in Bitcoin instead of 1 billion or 1.5 billion? That matters. Is that in your model? No, it's not in the model because no one ever did it before this year, right? So you couldn't have it in your model. So that's why I think the models are only interesting in a closed adiabatic system with no new actors, with no new developments. But there's a pretty big development here. It's $400 trillion worth of monetary energy sitting in weaker assets.
Yeah.
And so another way to say it is 400 trillion gallons of water that are in a reservoir uphill from you. And if I poke a hole in the dam, that 400 trillion gallons of water is going to want to flow downhill. And when that flows downhill, it's going to wash out your hedges, your playgrounds, your cities, every beautiful structure you've built, your sculpture, your artwork, your ports, your fleets. Everything is going to get negated by the 400 trillion gallons of water flowing downhill. And so you really got to keep your eye on the dam and figure out at what rate is the monetary energy in the rest of the universe entering Bitcoin, because that is going to dictate everything much more so than any model. So hopefully that answers your question, right? Like, no, we're not selling it. We're not trading it. There's no exit.
You're not getting interest
strategy
on it either. You just got it. You're hodling it.
It's a very simple idea. Wait for the water to flow downhill. And by the way, stay kind of out of the way of the water.
Yeah.
You want to make money on this, set up a little turbine. And as the water flows downhill, turn the turbine and you can extract some hydroelectric power off of the water flowing downhill.
Yeah, I think that's good. I mean, figure out what you can do to help the flow. I mean, that's why I do this YouTube channel. That's why I started this YouTube channel years ago. Was because, I always use the example of Wells Fargo. They got real big by selling the shovels during the gold rush, selling the tools for people to make money. And that's what we try to do here with education, and bringing on guests like yourself.